At this stage, we're still keeping our 2024 GDP forecast unchanged at 4.8%. And for 2025, we're also keeping it unchanged at 4.5% at the moment. So based on our analysis, if Trump administration will be putting a blanket 60% tariff on all Chinese imports, it will likely to trim China's GDP by about 1% as the base case. However, we also expect the Chinese government to be mitigating such a growth pressure by either stimulating domestic consumption or using more fiscal measures. So we do look for a more proactive fiscal policy to be announced at the MPC next March. What we have seen so far is that they have indeed increased some government bond issuance, but it falls short of expectation at this stage. We believe the real meeting to discuss potential implication and response to the new U.S. administration would be in December at the Central Economics Work Conference, which will lead to more aggressive monetary policy easing, fiscal support into 2025. But nonetheless, net export contribution to China's GDP will still decline. It was a very high number so far this year at north of 20%, and next year it can get much closer to zero, and that will likely to weigh on China growth.
What did you make of the industrial profit numbers yesterday, indicating that deflationary pressure remains in China and is very much a risk?
We believe deflation. Indeed. So we believe deflation will continue, or deflationary pressure will continue in China, especially based on the previous experience during trade wars, either between U.S. and China or U.S. and Japan. We have seen historical data telling us that inflation, especially PPI inflation data, typically would fall to the negative territory during such a period. And this time we see no exception. We have already seen China's PPI inflation declining further in the last reading, and we believe that there's a high chance for China's PPI inflation staying negative throughout the entire 2025, despite a much lower base.
What about the currency offset? How much do you think China would leverage on that?
We believe this time around, China would leverage unlimited devaluation of the CNY. The last time around, during early 2018 to late 2019, when U.S. increased average import tariff on Chinese goods from 3% to 21%, we have indeed seen CNY devaluated against the dollar by about 14%. But that was on the back of the background that the DXY itself, the dollar index itself, rebounded by more than 10%, which means that the bulk of the depreciation against dollar was due to dollar strength. This time around, while we believe China would still allow CNY to modestly devalue if the dollar stays very strong, it will more likely to leverage its domestic consumption. A very ironic number tells us that China has actually just become much more export-oriented or depend on external demand after the trade war, with net export contribution to GDP rising to an average of 11% since 2018, from a negative contribution of 3% since China entered into the WTO in 2001. So we believe it's now time to switch back to stimulate domestic demand and let domestic demand play a larger role. And as such, we are only looking for dollar CNY rising to about 7.35 by mid-2025, and we are still seeing the pair at 7.20 at the end of this year as well as next year.